Good afternoon from here in the United Kingdom. It's Thursday, the 10th of July, and wherever you're joining us from today, I'd like to warmly welcome you to this webinar co-hosted by General Index and Parameta Solutions. Our topic today will be From Certificates to Commodities, the Financialization of Guarantees of Origin. My name is David Elward, Pricing Director for Energy Transition at General Index, and I'll be your moderator for this webinar. Our expert GOOS guests today are Sara Cheraga, Pricing Analyst at General Index, and Victor Laurent, Global Head of Data Products at Parameta Solutions. Sara, Victor, thanks for being with us today. So we'll kick off the webinar in just a moment, but first a couple of housekeeping items. This webinar is being recorded and will be made available to you after the event. We'll also be holding a question and answer session at the end of the formal presentations. The Q&A function at the bottom of your screens is now live, so please feel free to submit any questions as we go. Well, now, really, without any further ado, let's get started. So just to very briefly introduce the partnership that we have put in place, not only between General Index and Parameta Solutions, but also on this really kind of innovative and first to market initiative, jointly with Clean World and NMAC as well. We are collaborating on a series of new indexes within this guarantees of origin space. And Sara will talk through now a little bit more about what this partnership entails. We're really excited about it. Thanks very much to Parameta for joining us today. And we look forward to these discussions. Sara, over to you.
Thank you, David. So for these indexes that we have recently launched, we have partners with three major brokers. So Clean World, NMAC, and Parameta Solutions. So Victoria is here today with Parameta. And so we have launched around 40 prices that cover a wide range of technologies, such as nuclear, hydro, wind, solar, and renewables. And then I'll go a bit more into depth into this. If you can go to the next slide. So I thought it would be good to give everyone a little bit of background context on what guarantees of origin are. And just to set you up in the context, so those kind of certificates, so environmental certificates, they have initially been introduced in the market to address what we call information asymmetry. That's a regular problem that we see in energy markets, which means that when you are a consumer of energy, you cannot really distinguish between renewables and non-renewables once the electrons go into the grid. And so this is where the certificates like guarantees of origin come into play. They're basically meant to give you a bit more transparency for the consumers, but also for companies, just to verify the source of the electricity that they consume. So basically, guarantees of origin are the ID card of your electricity, and they are the instrument that ensure that you can trace back the renewable energy all the way through the supply chain. And they mainly serve two roles. So there's a regulatory and a voluntary. In terms of regulatory, they are regulated by a major piece of regulation in Europe, which is called the RED, so the Renewable Energy Directive. And it basically says that consumers have to be informed about the source of the electricity that they consume. And so guarantees of origin are one way to do that. And there's also the voluntary aspect, because companies who buy those certificates, they can do so as part of voluntary sustainability strategies. So even though it's not fully mandatory, they can do this to show that they are consuming a certain amount of renewables. And that's particularly relevant when you look at Scope 2 emissions accounting. And there's initiatives that have been put into place by companies such as RE100 that you might have heard of, where big companies like Google, Apple, or IKEA have basically said, we are going to try and power our operations with renewables. And so guarantees of origin are a way to do that and to prove that they're doing this. And this market is basically mainly driven by those kind of initiatives and also the growing regulations. So it's expanding as the years go by, from electricity to other carriers. So we've seen for hydrogen or biomethane as well. So the regulation is starting to slowly pick up to more than just electricity, and all the net zero and ESG frameworks are some of the core drivers behind this market. So if you go into the next slide. Now onto the data side of things and how we've created benchmarks for this market. I wanted to give a little bit more details about how we process. So we operate on a 413 market close, and we have a clear hierarchy of the data and how we assess it. So we take priorities for trade, of course, because they really reflect the market activity. Then we have orders coming in, and then we also take into account indications. And then those pieces of data, we have a clear methodology by which we assess it, and then it's published daily on our platform. I've put a screenshot on the right-hand side so you can see an example of that. And if you go to the next slide, there's a bit more detail about each of our indexes. So each technology and each vintage has its own identity card, where you have a bit more detail about the methodology, the price history, and the flow chart as well. And so this is delivered via different means, so whether it is API, Excel, etc. So all of this is for every index that we have launched. So if you go to the next slide, I want to touch a bit more upon the price trends. So I've put here a graph that gives you a bit of an overview of the markets. So this is an example with the 2025 vintages across all the technologies that we have. So you can see that it's quite a fairly volatile market, and we'll touch on some of the factors that influences the prices after. So they are in euro per megawatt hour. And if you go to the next slide, I want to do a little bit of analysis on what we've seen so far for June in terms of trade across all the technologies. So you can see that really what jumps is the amount of wind, hydro, solar bundle guarantees of origin that have been traded. So they quite clearly dominate the market as of now. So they are mainly traded as we've seen in June, but also we can see that hydro is still quite a big part of the geo trading, which kind of sustains the oversupply pressure, especially from the Nordics region, even though now in summer there's a bit less activity. We can see also quite interestingly that the demand for wind is quite steady, but it's mainly through the bundle, so wind, hydro, solar, that we see most activity. And solar has a little bit of a breakout, but it's not that much in comparison. So that could be for different factors, such as scarcity, but also because they usually trade at a premium. That's a point that I will get back to a bit later. And if you go to the next slide. So those prices, the guarantees of origin, they are influenced by different factors. And like any commodity, you have supply and demand that influences that, but also the way they are traded, so the market structure. So the guarantees of origin, they don't really have an intrinsic price like electricity or gas, but their market value depends on different factors. It could be scarcity, strategic demand, and also supply and demand. So in terms of supply, the volume of geos kind of depends on how much renewable electricity is generated. So usually you would see that the systems that are more hydropower dominated, such as the Nordics region, so Norway, Sweden, etc., they would usually produce large volumes of geos at a lower cost, which usually can put a pressure on prices. Usually they would be quite low. And we've seen over the past couple of years this trend where there has been a lot of oversupply from hydro on the market, and that can lead sometimes to near zero euro prices per megawatt hour. And also some tech-specific guarantees of origin can have premiums or discounts as well, but I will touch on that a bit later. And there's also this seasonality and weather that's quite important. It's a big factor because, for example, if I take the hydro, when you have wet years, usually that increases the production of hydro, so you would have more issuance for those types of guarantees of origin, and that can put a downward pressure on the prices as well. So there's really a seasonality that's quite important in this market as well. And there is also a point about the issuance rules, because those certificates expire 12 months after the power generation, which also means that it limits how they can be held and traded for how long. So that's also something to keep in mind when looking at the supply factors. On the demand side, I've touched a bit upon it, but initiatives like RE100 or major corporations that have net zero goals, they really drive the demand for guarantees of origin, and especially as you will get more and more firms that will adopt market-based scope 2 emission accounting, the demand is expected to rise. Something that's also important is national targets. So regulation is still evolving in this market, but it's picking up. And in some countries, the energy suppliers are legally required to disclose their energy mix. And so they would use guarantees of origin to verify that. So you have countries like Austria or Switzerland that have really strong disclosure frameworks. So that really supports a more compliance-driven guarantees of origin market. And then you have also the market structure. So those certificates are mainly traded over the counter, so through brokers or bilateral contracts. That leads to some issues of transparency and fragmentation that we'll touch upon a bit later. That's something to keep in mind. And also increasingly what we see is quite interesting is that we also have exchange that trade those certificates. So you have, for example, EX that have geo spot and futures products. So there are some benefits associated to that, which is, for example, better visibility, also a bit more liquidity on the market. It's still a small portion of the market, but it's probably expected to grow as well. And if you go to the next slide, I want to dive in a bit more into some of the regional and technology-based differentials, which is a really important point when we're looking at the guarantees of origin market. And the first bit is regarding the market demand and also the supply imbalance, because as I've mentioned a bit before, when we look at Nordic hydro, it's very abundant in the market, and usually that creates very low prices. We often see trades or bids and offers that are below €1, sorry, €1 per megawatt hour, especially for the current vintages. Whereas if you look at the countries like Italy or Spain, so for Southern European countries and solar guarantees of origin, they usually have more of a premium because there is a tighter supply and also there is high, it's well seen for corporations as well. And there's also this idea that it has a perceived additionality or scarcity. So usually those guarantees of origin trades at a higher prices. Then we also have residual mixed effects. So when you have regions where the grid electricity is still very much carbon intensive, the geos are usually seen as more impactful and thus more valuable, whereas countries that have more greener grids, they may see lower prices because there's less this idea of it will bring more renewables into the grid, so less additionality. And another point that's quite important, it's regarding regulatory differences. So you have some countries that have restrictions. So for example, if you look at Flanders, the region in Belgium, they can only import geos from or export geos to countries that are both in the European Economic Area and are also a member of the EIB. So for example, the Swiss guarantees of origin, they cannot be imported there because Switzerland is a member of the EIB, but not of the European Economic Area. So you have some restrictions depending on the country as well. And you also have national support schemes and eligibility rule that can shift the demand preference. And if you go to the next slide, I want to go a bit more detail into the technology-based premium that I kind of touched upon. But for solar is quite interesting because a lot of the European countries have quite low solar penetration comparison to wind or hydro. So usually those guarantees of origin are a bit less available on the market and they are way more valuable. So sometimes we see Dutch or Swiss solar guarantees of origin that have very high prices. Whereas wind, for example, is more of a mid-range. It has quite a strong demand from the corporations, and it's often used also in PPAs as well. So it's less scarce than solar, but it's also a little bit more desirable than hydro because it has a lower emission footprint overall. And hydro guarantees of origin, they're usually flooding the market, so there's high availability, especially from the Nordics countries. The only issue is that sometimes the additionality around those guarantees of origin is a bit lower because they tend to be from older installations. And something that's quite important as well to look at when looking at the prices is the impact of the asset age and the vintage. So just to clarify, the vintage is the production year of the electricity that's associated with the guarantee of origin. And then the asset age is just the year that the renewable plant was commissioned, so when it started to operate. And those two things impact the price because GEOs from newer plants or recent vintages can have a more premium value because there's different things like perceived additionality, but also the fact that it aligns better with some brands and also the reputational risk. So if you would look at, for example, recent vintages like 2024, they would be useful for year matching scope 2 audits, so they might be preferable. So I think what concludes kind of this big parts on pricing and markets is that guarantees of origin are not really a one-size-fits-all products. So the prices really depend on where and how the electricity was generated, which is kind of important for both the traders and corporate buyers and whoever is interested in this to understand not just the certificate, but also all the origin stories that go behind it. So the technology, the location, and the vintage, all of these parameters matter in terms of price formation. So now I'll let Victor take on the second part, where he will tell you more about some of the data challenges in this market.
Thank you, Sarah, for the explanation and a perfect segue to my bit of the presentation. So indeed, guarantees of origin face several types of challenges, and there's also an increasing effort towards market transparency. So I'm going to cover this in the next 2 slides. And then I'll wrap up this presentation with 3 use cases, looking at how we can apply, the guarantees of origin index into real life situations, and then take you through a user journey. So on the data challenges, so to piggyback on what Sarah just said earlier, the very first challenge really relates to how fragmented the reporting is. The market is decentralized, data is spread across national registries, numerous different brokers, private bilateral deals. So for example, a buyer might see one price in the German registry, but have no visibility into deals happening OTC in Spain. So one registry may report generation monthly, another registry may report quarterly. So all of these differences make it difficult, to compare. In fact, over 40% of guarantees of origin trades are estimated to happen OTC, which means very limited price transparency, creating blind spots and pricing and demand. And that's exactly why we brought the guarantees of origin index to market, to bring light and transparency to an opaque market. On the right-hand side, you also see there's a lack of standard disclosure. So without harmonized reporting, verifying the real impact of guarantees of origin is challenging. Let's say, for instance, a solar guarantees of origin is issued in Italy, but then sold in Sweden. If that guarantee of origin is bundled into a PPA, which is a power purchase agreement, and then split between different subsidiaries, there's a high risk of double counting. Actually, some research shows that up to 15% of the guarantees of origin certificates are double counted or inaccurately distributed. So this lack of clarity complicates the due diligence process, increases the risk in terms of ESG reporting, and especially when you're a corporate trying to meet your scope 2 agreements or trying to follow a framework like the CDP or the RE100, it can be quite difficult. On the second slide, so if you go to the next slide, I'll discuss the effort towards transparency. So here, a critical enabler of guarantees of origin is really the trust in the market. In order to build that trust, it's very crucial and paramount to bring transparency. So this slide highlights 2 main driving forces behind that transparency. So on the left-hand side, you'll see the blockchain, and on the right-hand side, the digital MRV system. MRV stands for monitoring, reporting, verifying. So first, let's talk about blockchain on the left. So some platforms are now piloting blockchain technology to track guarantees of origin across the entire life cycle. So really from issuance to retirement. That has many compelling benefits, tamper-proof audit trails, real-time tracking, a much stronger assurance for buyers, and also legitimate traceability. However, it also comes at costs or challenges. Scaling blockchain solutions and integrating them with the national registry, especially, can be quite some work. So the direction is good, but there's a lot to go to be successful. On the digital MRV systems, so these tools, they're used to automate the tracking of renewable energy generation and the issuance of certificates. So they're especially valuable for small scale or decentralized generators where manual tracking is often, error prone. So again, this allows to bring some transparency to the system and increase the trust. So moving on to the next slide and to different use cases. So 3 use cases are going to be covered today. So the first one is about a utility use case. The second one will be a corporate buyer, and the last one will be a green fund. So on the utility, that first example, so between E.ON and RWE in a wind partnership. So what happened here is, in that case, E.ON secured a 2.5-year power purchase agreement with RWE. So they're sourcing guarantees of origin for more than 20 wind turbines. And these farms, they have a combined capacity total of close to 900 megawatts. It generates about 3 terawatt-hours of clean electricity every year. So to give you an idea of comparison, that's enough to fully cover the electricity needs of E.ON for its entire UK customer base. And all of that while ensuring 0 scope 2 emissions. So scope 2 emissions is part of the European emissions reporting that utilities need to comply with. So considering the size of the investments is quite big, E.ON has committed 3.3 billion into renewable energy. And that model is guarantee of origin backed model, allows them to offer carbon neutral tariffs without passing extra cost into customer. So to summarize, it's E.ON matches 100% of its residential electricity supply with its guarantees of origin certificates. That means that the customers, they get clean, green, transparent energy without paying a premium. So that's a good example here of how large case, cost-effective decarbonization is possible when you bundle guarantees of origin in your model. Number 2 will be a corporate buyer, if you go on to the next slide. So in this case, ENGIE signed, OI Glass is a glass manufacturer in Europe, one of the big ones in France. So in that case, ENGIE signed a 10-year PPA with OI to supply renewable electricity from, to Sarah's point, from solar, for wind, or from hydro. So the power that OI's European glass manufacturing plants is using will be green. The agreement covers 4.3 terawatt hours of clean energy, and that is going to be over the span of 10 years from 2022 to 2032. To give you a sense of scale again, OI generated 6.4 billion in revenues in 21. So it's a major industrial player making a serious climate commitment. Again, this is a trend that we're seeing, and that's exactly why the Guarantees of Origin Index can help corporate buyers in that trend. So the impact there was that OI could accurately report its emissions, scope 2. It could align with the CSRD, which is Corporate Sustainability Reporting Directive, and they reduced their greenhouse gas emissions by 25%. At least that's the plan by 2030. So it also boosts the renewable share in their energy mix. It's pushing it up to 30 to 35%, which is a big leap considering it's a heavy industry, especially glass manufacturing is known not to be so clean. So in the long term, it's going to bring confidence. It's going to bring ESG-driven procurement decision, cost-free, and it's going to be more attractive to investors. And then the last example will be about a green fund. So going back to financial institutions, and then it's in that case, let's look at so EEX, the European Energy Exchange, and the Guarantees of Origin Futures Arbitrage. So how to optimize this in the market. So in that case, we use color-tracked guarantees of origins like hydro, wind, and solar, and the European Energy Exchange, EEX. So the funds are currently actively arbitraging between the price difference between different regions and different technologies. That goes back to what Sarah was saying earlier. So for example, a fund, so they can buy low cost Nordic hydro guarantees of origin at, say, €1 per megawatt hour per certificate, sorry. And then they can sell higher priced Central European or Southern European solar at 2. So that's, for instance, 100% price spread between the two. All of these different price spreads in terms of technology and regions can go, way and beyond 100% of spread. So in 2024, on average, the spread was about €1.20 per guarantee of origin. So if a fund traded about 1 gig of peak worth of guarantees of origin, they could have generated, roughly, 1.2 million in revenue. So again, this is full arbitrage, so with limited risk. And another added advantage is that this strategy delivers those returns completely uncorrelated to volatility in electricity markets. So you basically allow your fund to get an extra alpha of 2 to 5% without increasing your correlation to other markets and actually increasing your diversification. So in short, it's a smart way to turn an environmental asset into a financial performance, which ties back to the commoditization of the product.
Thanks, Victor. Thanks, Sarah. Okay, well, we'll now pivot to some questions. As I mentioned before, the Q&A function at the bottom of the screens is active. Please feel free to submit any questions that you have. We've had a couple come in already. Victor, I'll pick up on one with you first. I mean, you've covered a little bit of this already, but the question is asking, with CSRD and the Green Claims Directive coming into force, how do you see GOO benchmarks being integrated into corporate renewable procurement strategies or PPA negotiations? Perhaps you covered a bit of that, some of the examples, but perhaps you could also highlight as well, are contracts starting to reference these indexes specifically? I know it's quite early days. We've only recently launched them, but what would you anticipate perhaps in terms of next steps as part of that work?
So, I mean, as driven by CSRD and all the green claims and directives, I mean, there's definitely room for growth. We see the benchmark business becoming central to corporate renewable procurement strategies. Also looking at PPA negotiations in order to finance your different projects. People really need to find leverages and sources of income wherever they can. So when governmental structures such as guarantees of origin or the green push from governments, it allows to build up schemes that allow to finance those projects. So you evaluate your guarantees of origin offer, you negotiate your PPAs, and you align with your ESG goals. Again, this goes back, it can be an indirect cost, but if you're audited and do not follow the requirements that you need to follow in your green pledges, the costs are much higher than the actual initial cost to set something up. Regulatory pressure will keep adding, driving adoption. We've seen the green agenda really increase in the last, especially since Russia invaded Ukraine. Every target that the European Commission made as a green pledge was doubled or tripled once we moved away from Russian gas, and that was driven by the Repower EU directives. So again, what I'm trying to say here is that the direction is very clear, and we aim at playing a central role in that green offer with the guarantees of origin.
Thank you. Sarah, I'll turn to you. So another question that's come in, perhaps you can put a little more, perhaps a little more detail on some of the kind of dynamics in the market. So You were mentioning how guarantee of origin prices vary by region, technology, like hydro, wind, solar, nuclear. How do these price differences manifest across European markets? I guess you picked out some differences between like the Nordics and other regions, but perhaps you can elaborate on that. What key drivers are behind some of the most significant spreads that we see?
Yeah, so I think it kind of goes back to what I was saying around the differences between countries that have lower penetrations, for example, solar. So you have countries that would have less sun, so they would produce less electricity. So that's one of the problem also with those markets is that there's a lot of imbalance. So the Scandinavian countries, they would produce a lot more hydro than other countries, and usually that would put a lot of pressure on the prices. So that's why you would see sometimes current vintages for hydro that would be almost near to zero in terms of prices. There's also different drivers. I mean, regulation is definitely one of them. So CSRD, but also RE100. And as that becomes a bit more mandatory, because right now it's mainly a voluntary market, but as there is a bit more stricter regulation, that will put more pressure on companies to actually report on the scope 2 emissions and then to actually back this with the guarantees of origin. And then that could put more pressure onto the markets as well. So I would say there's different factors. There's the technology, there is the penetration rates in different countries as well. And there's regulation, whether it is at the European level, but also in terms of disclosures that are specific to each country that also influences that.
Okay, thank you.
We also on the supply and demand angle, weather. So weather volatility. So if there's more wind, there's going to be more green electricity produced. There's going to be more guarantees of origin issued. So weather volatility has an impact on supply of GEOs.
Thank you both. Okay, I'll take the next question that we have from the Q&A functionality. How do you see GHG protocol revisions on market instruments and scope 2 impact in demand for guarantees of origin? Do you see the hourly matching or regional matching requirements on electricity consumption as negative for GOO's demand with the current market structure? Who wants to jump in on that one first?
I mean, my quick faraway answer would be it's going to be difficult to implement. I understand where they're coming from to match hourly instead of matching yearly. I would say, I mean, just like generally speaking, right? If there's an overkill of regulation, it becomes detrimental to a market. Obviously, we want to drive the market forward. So we want to increase reporting. We want to increase the reach. So we want to go out to more corporates, more financials, more manufacturers. And we want to expand the geographic coverage as well, maybe beyond Europe, just like we saw in the compliance market and the CBAM, looking at bordering countries outside of the internal market, domestic markets. So why not? But going down to hourly reporting instead of yearly becomes more of an exercise of actually how am I going to even account for it. So I'm curious to see developments. I think it's a bit of an overkill.
Sara, anything to add on that?
No, I think that summarizes pretty well.
Okay. Some other questions. Victor, you just touched on the potential negative impacts of kind of regulatory overkill. But sort of a variety of other questions that I'm looking at sort of offline. So kind of touch on this area. So some guarantees of origin are criticised for not reflecting true environmental impact if improperly managed or tracked. What are the risks of greenwashing or double counting in the current GOO system? Like you touched on some of the double counting, and how some of the registries are addressing them. Perhaps you could elaborate a little bit on like if double counting is happening within the system, that like what more can the industry do to solve this? Does it have to just sort of over centralize in order to avoid this? Like what are the options?
Yeah, so the option is simplification, I would say. So having a central registry and having very clear metrics as to how you account for issuance and retirement. I know that there are a few startups out there that try to actually help the tracking. I'm thinking right off the bat, I'm thinking here about Silvera that's tracking offsets. So it's not exactly guarantees of origin, but it's in the green world. Offsets, so basically you offset the pollution. You don't reduce your pollution, but you buy an offset that proves that something that a tree offsetted the pollution you emitted somewhere else. GOOs, they prove that the electron you're using is green. I mean, if we have one central registry, unified the way we unified the power markets, just like the grid is unified, we'd be able to, or even simply matching up the production against the total issuance per year. There could be a sort of audit. So central registry with an audit every quarter to make sure that the total volumes of guarantees of origin issued is actually feasible, for instance. Is there enough renewables out there that can even produce as much? That, for instance, can be some easy checks to put in place.
Sara, anything else to add in terms of?
Yeah, I think tracking is really the most important thing because, as Victor mentioned before, one of the problems is how not homogeneous the tracking are amongst registries in different countries in the AIB. And the thing is, to avoid double counting, you have to really make sure that only one guarantee of origin certificate is issued per megawatt hour. And so if you have a more uniform way of registering and tracking all of these guarantees of origin from the beginning to the end, so throughout the whole life cycle of the certificate, that then ensures that you can avoid those kind of issues of double counting. So make sure that the actual guarantee of origin is properly retired when the green attribute has been claimed at the end.
Okay, thank you. We've got a couple of minutes left. Just to reiterate, a recording of this session will be shared after the webinar. So that will be done in the next day or so. Please keep an eye out on your emails where you registered, and that should come through. Perhaps time for a couple more questions. Maybe I'm going to sort of slightly rephrase this question, but what role do you think that perhaps kind of AI or Gen AI might have to help perhaps solve some of these questions that we've been talking about, some of the sort of the regulatory issues, some of the tracking issues, and are there ways that we can incorporate that to kind of generate a kind of greater insights overall in this new space for us?
I don't really have an opinion on.
No, on AI.
I mean, the one AI module that could be used to enhance that would be to integrate a module to the database that hosts the data. So I think slide number 4, Sarah showed, the trades, the orders, and the indications, so the indicative assessments. So say that could be 3 tables with 3 degrees of importance, and then you put in an AI module that allows to query the database in a natural language. So for any product manager or a reporter or even a journalist that wants to get some intel or information out of the data in terms of trends, in terms of forecasts, or in terms of just understanding how things work, they could query it with a natural language and get their answers straight from the database. So that would be a way to leverage AI on these products.
Sara, any other thoughts?
I don't have any particular use case at the top of my mind now.
Okay. One certainly that we'd be looking at more, it's sort of obviously AI is quite far at the top of a lot of sort of business environments at the moment. We have one further question in the chat. What impact do you expect from the double whammy of the temporality and geography provisions of RED 2 and RED 3 and similar e-fuel related legislation, will we see two distinct, they've taken the question away from me, sorry, will we see two distinct markets develop, local and live versus broader?
Good question. I mean, yes, short answer is yes. As long as the market stays voluntary, it's going to stay fragmented, and everybody will pursue opportunity at and trying to manage their costs. So if there's a market that has liquidity that serves a purpose, it will grow. So, for instance, on the location or the technology, it could also be that maybe both will grow in parallel, and then the most relevant one will stay and will become compliant.